Hello, we're Precedent Wealth Partners. Let's talk. Drew, good to be here with you. I think our goal today is to really talk about some of the evolution around tax strategies and charitable giving. And I think mainly because there's been some changes recently.
Yeah.
I thought maybe what would be good is just to start out by refreshing everybody on kind of what the historical landscape has been, for clients trying to get tax benefits associated with their charitable gifts. You want to just kind of give a recap of that?
Yeah. Gosh, where to start? I think when we think of charitable giving, it's helpful to take a step back and have an overview like this, because often, we, your clients, will think, well, I'm writing a check, I'm giving it to a charity.
Yeah.
Maybe I get a tax deduction for that. And, there's a little bit of nuance to it, and there's some other ways to get tax advantages, through charitable giving. And so I think it's important to kind of step back and look at the full landscape, and then take into account some of the changes with recent legislation, as you referenced.
Yeah.
Charitable giving is giving assets to a qualified charitable organization. We're going to get into this, but that could be cash, that could be appreciated securities.
Yep.
Or other property of some kind, and there's some different rules, that apply to cash versus if you're giving securities,
Right.
Like that. There are some charitable options, from an IRA that we're going to talk about. So that's
Yep.
another dimension to this. And then the overall tax picture is very important. How do you actually get a tax advantage from giving? Is it from any gift you make? Is it only gifts above a certain amount?
Right.
Does it have to be a specific kind of gift? And so we're going to talk about all that today as well.
Well, and probably, it's good to just refresh everybody a little bit. We've been, until this past year, kind of under a standard set of rules that have been around for a little while. Mm-hmm. And that is that most of the benefit associated with charitable giving was really kind of honed in and directed to people who itemized their deductions every year. Mm-hmm. But
that's a small percentage of people.
Well, for people that follow
recently.
it's gotten smaller and smaller, in fact,
Yeah.
as time goes on. And I think some of the latest figures I've seen is that just a little over 10% are now itemizing deductions. So
because that standard deduction has gotten
so
large.
It's gotten big enough that there's no real advantage to itemize unless you have really, really big numbers. And so,
Exactly.
You can obviously still take a charitable deduction if you itemize. And you can do that whether you give cash or whether you give, appreciated securities.
Right.
But I think, we want to talk about some of the changes in the bill that passed last year, the One Big Beautiful Bill, because it broadened the landscape for people on regular charitable gifts.
Yeah, absolutely.
You want to talk about that?
Yeah, that standard deduction we're referencing, for a married couple filing jointly, that's north of $30,000, and typically increases every year. But some of the things you can deduct: charitable gifts, obviously, mortgage interest, state and local taxes. There are a few other things, but like we said, most people are not hitting that number.
Right.
With kind of routine
because until some recent changes, state and local taxes were capped at $10,000.
Exactly.
That was the most you could count.
Yeah, and most people, that's probably their biggest eligible deduction.
Right.
But they were limited on that until 2025, as you said. But something interesting happened in 2020, starting this year, as related to the One Big Beautiful Bill Act that passed last summer. So beginning in tax year 2026, non-itemizers, can now deduct. So that's a $1,000 deduction for a single taxpayer, $2,000 for married filing jointly. And that's important to note because, a lot of people may be giving charitable gifts every single year but are not reaching that standard deduction threshold where they're itemized. And so now all of a sudden there's room, if you're not itemizing, you're taking standard deduction, you can still get some benefit from
Which really means
gifts.
It's important for people to be aware of that who have gone along maybe the last few years and they've just kind of forgotten about collecting receipts and keeping track of
not
this.
telling their CPA about it.
Because they don't think there's
small.
really any benefit since they're taking the standard deduction. And
Exactly.
So now they need to capture that information and be sure they give it to their CPA.
Absolutely. There's also kind of an inverse change with the law that actually kind of hurts itemizers.
Right.
Starting this year, if you itemize, you have a 0.5% floor as a percentage of your adjusted gross income. If charitable giving, that does not count toward a deduction. So if your AGI is $100,000, you can give $500 in deductions, and you don't get to claim that as a deduction.
Right.
So that's kind of the inverse of, if you've got some benefit for people who don't itemize with the recent legislation. And
leveling the playing field.
Itemizers have
bit.
a little bit, they have a new threshold that they have to clear. So
Yeah. Well, good. And we probably ought to talk a little bit about this distinction. You alluded to it between cash gifts and giving appreciated property, to charity, appreciated securities. Cash gifts are pretty simple. I mean, if you give $1,000, you can deduct $1,000, either over directly on the tax return on page 1 if you don't itemize, or you can use it as an itemized deduction if you're itemizing. And so that, as long as it's going to an eligible charity, and that's really any so-called public charity, which is technically under the tax rules, is you hear the term 501c3. That's the section of the tax code that defines a public charity. Those are fully deductible. But what a lot of our clients find is that maybe it's better off, they're going to be better off to, instead of giving cash, take an item out of their portfolio that's appreciated in value and give that instead to a charity. And you can elaborate on really what the differential is there in terms of the benefit. Well,
the biggest thing, and typically if you do that, you're going to go to your portfolio. Maybe a client has a share of Apple that has appreciated for 20 years and is up. I don't know what Apple is up over 20 years,
bunch.
but 1,000% or something. And they could say, well, I'm going to sell that security and give cash. Well, they've got to pay capital gains tax on that gain. If they just give the share of Apple without selling it, they can make a transfer to the charity of that security specifically. They avoid the capital gain altogether.
Right.
So they've got cash maybe on the sideline that they would give. Well, instead they can give securities or shares of something, backfill that amount with the cash that they were going to otherwise give as a gift. But they've avoided the capital gains tax, and they still get a deduction of the fair market value of the security. So it's kind of a double tax advantage.
Now, we ought to point out that there is a distinction between cash gifts and appreciated securities gifts in terms of how much you can deduct. And if you're getting into some larger amounts, this could come into play for some people.
Yes.
When it's a cash gift, you're able to give up to 60% of whatever your adjusted gross income is in a year. We're talking about as an itemized deduction.
Yep.
And fully deduct it that year.
That's right.
When you start giving these appreciated securities, you have a lower percentage, 30%.
That's right.
That's eligible to be given in that year. Now, if you go over that, you don't lose it. No. There is a carry forward.
Yeah.
And you can claim some more of it the next year up to that 30% limit.
That's right.
And you've got really 5 additional years to soak up anything that doesn't get used in the first year.
Exactly.
So,
that 5-year carry forward is pretty powerful. That probably doesn't apply to kind of the average
most
taxpayer
people aren't going to run up.
Gifts.
Most people aren't giving away 30 to 60% of their income.
Yeah, but maybe someone has a large bonus. They have a gift that they've been kind of planning for years, and is a larger gift amount that they've been kind of storing up for that would exceed 30 or 60% of their AGI.
Right.
As you said, they don't lose that deduction. They get to carry that forward.
Yeah.
Usually 5 years is a pretty substantial amount of time.
We probably ought to talk a little bit about the sort of a segment of our clients that are in the kind of the retired category. But by that, I'm specifically meaning people that are over age 70 and a half and who have IRA type retirement balances, because we've got this provision that they can pull money out of that IRA and send it directly to charity without paying tax on it, having it be excluded from their taxable income.
Yeah.
I think those are called qualified charitable distributions.
Qualified charitable distributions, often we'll call these QCDs. That amount is $111,000 for 2026. So if you've got an IRA of $1 million, you can take $111,000 out of that IRA and give it straight to a charity.
Send it to as many charities as you want, as long as they're qualified.
It doesn't register to you as income on your tax return. Some important things on QCDs, I think. They can go against your required minimum distributions. So there's another acronym,
So for our
RMD.
people that are over 73,
Yep.
That have to take RMDs, they can actually direct some of that money to charity and satisfy their
lowering
RMD
that RMD
without
amount.
paying tax.
Exactly. I think maybe the most powerful aspect of the QCD, and it depends on how much you're giving, this doesn't really determine, if standard deduction or itemizing really has no effect on the QCD impact.
This is a subtraction from the top line.
Exactly.
Yeah.
You don't have to itemize to get a deduction for making a QCD, which is pretty powerful for a lot of people that aren't at that limit. But.
And that figures in, this is getting a little bit down in the weeds, but some of our retired clients pay a lot of attention if their income is a little higher to how much they're paying for Medicare because there's an income test.
Right.
And by giving, as opposed to taking your money out of your IRA, giving it then to charity and taking an itemized deduction, the test of your income is determined on page 1 of your return.
Yeah.
If you instead direct these qualified charitable distributions directly to a charity out of your IRA, they get subtracted on page 1. That page 1 income is lower. That may reduce your Medicare premiums.
It could,
depending on where you fall.
Or certainly prevent you from an increase that you would have otherwise expected.
Exactly.
Yeah, so that's pretty powerful. There is an age, I forget the origination of this. 70 and a half is the age of QCDs. RMDs are 73. Those go up every year.
It would be interesting
QCDs.
to know who in Congress was about to turn 70 and a half when that was originally enacted that decided on having that cut off.
Yeah.
What a confusing.
There's some backstory there that we're not aware of.
Tax legislation.
In the legislative halls there.
Maybe for a future video, we'll do some research on that. See if we can figure out how that ever
if that's much interest
came to be.
We'll see. I think another account that another aspect of charitable planning that could be really impactful is something called a donor advised fund.
A DAF.
DAF.
Yes, right.
Sometimes we call them DAFs. A donor advised fund is powerful because it really lets you take control of the timing of your charitable giving. And so if we're talking about maybe itemizing deductions, you want to itemize as much as possible in any given tax year.
Right.
And so by using a donor advised fund and kind of the mechanics of that we'll talk about in a second, you can really sort of control when gifts are made. A donor advised fund it's a separate account. It's technically its own entity. It's like a charitable entity. So
these accounts are readily available. I mean, our clients mostly use brokers like Schwab and Fidelity. They both offer these.
Exactly. If your accounts are at one of those, you probably are just going to open it at the same custodian.
Right.
But the way that account functions is when you make a gift to that account, it's like a completed gift to charity. And the difference is the funds are still in that account, and you can control the distribution and allocation of those funds and the timing of the actual gifts to the charitable organization.
That can be pretty valuable. I mean, if you think about our people that are maybe they itemize every year, but they're just marginally, above the amount to itemize.
35, 40,000, something like that.
You can see right off the bat there the planning opportunity. They could, at the end of the year, they could, when maybe they normally make their charitable gifts, they could double up and fund what they're wanting to give for the current year, but also put into that donor advised fund account what they're really going to give away the next year.
Yeah.
They're going to get all the deduction in the current year, magnifying their itemized deductions. Of course, that lowers what they could take as a charitable deduction the following year, but if they're close to the standard deduction,
just take standard.
They take standard the next year.
And that way you get, between the 2 years, a much bigger deduction
a bigger overall write-off.
On average.
Exactly. Exactly.
Yeah, we've got a client who makes some year-end gifts, also makes gifts throughout the year. And so recently, a planning initiative has been, in December, you're going to make your year-end gifts. You've already made these gifts throughout the year. And then the monthly gifts that you might give the following year, you're going to put all of those dollars into that account in December.
Yeah.
And you can still divvy them out, every month in the following year, but you get the gift in that original tax year.
That can also be helpful for people that might have a spike in their income for some reason, some, large sale of an asset,
selling
a bonus, some kind of thing that is pushing them up in a higher bracket in a given year. Maybe you double up or even triple up on some charitable deductions. You put your budget in and then you dole it out over the next several years out of that account.
Yeah.
So
it gives you a lot of flexibility and control over the timing, which can give you a lot of tax advantages. So
no, that's great. So and we didn't talk about it. It's a little beyond our scope here today, but that concept of timing the deductions and alternating between itemizing one year and taking standard the next. Some clients, particularly here in Texas, where you can basically pay your property taxes around the end of the year or in January of the following year, you can also really double up on your property tax payments in the year that you're going to itemize.
Yes.
Now, you're still subject to this floor. The floor for the next few years has been raised, though, for most taxpayers
40,000
from 10,000 up to 40, unless your income really gets high.
Exactly.
That can even enhance the strategy a bit more.
Yeah, I mean, we've done this with some clients recently. They pay something like $20,000 a year in property taxes.
Yeah.
Previously, they were only getting the benefit of half of that,
Yep.
and they weren't even really itemizing because they were right at kind of the standard deduction limit. And so now we've said, okay, you're going to pay property taxes in January and in December, so that's $40,000.
Yeah.
Basically at the cap, for
Right.
state and local taxes, but plus charitable
If they
giving.
double
that
up
they're
on
doing,
their charitable giving.
plus
yeah.
mortgage interest and
Yeah.
all sorts of other things. And so all of a sudden they're going from taking standard every year to 50,000 plus,
Yeah.
$50,000, $60,000
Be a significant
in
tax
deductions.
savings. So why don't we just let's recap the takeaways, and I want to say before we do that just a couple of things, because we hear things and there's confusion about this. You're never ahead of where charitable giving never makes you money. I think there's some misguided thoughts about that I can end up with more dollars in my pocket by giving money away. The tax rates are not 100%. That's never true.
That's right.
So you've got to have a legitimate desire to benefit some charities, but most people have some amount of that desire. Mm-hmm. And we're just talking about how then to maximize the tax subsidy of that.
Yes.
By good planning.
Yeah, not a silver bullet, but how do you, as you said, how do you optimize?
And I think the second thing that I would and we'll save this maybe for a future conversation. There's some more exotic and sophisticated planning techniques around charitable bequests. Generally, they tie in with people's estate planning,
Trusts,
trusts and things like that. Split interest trusts. Mm-hmm. We're not covering those today, but maybe we could let's just recap the big takeaways from today. Probably that would be important.
Yeah, I think it's important to pay attention to standard and itemized deductions. If you're someone who gives kind of a minimum amount to charity every year, make sure you're taking note of that now that the law has changed, and you can get a deduction even though you're not itemizing, perhaps. Important to look at, if you have appreciated securities that could be more optimal to give than cash.
And they've got to be in a taxable account, not in an
not
IRA.
a retirement account.
That doesn't help you.
Exactly. Yeah. And you'd kind of target, what's most appreciated there. That would be the ideal.
But if you're
asset.
if you're over 70 and a half and you do have an IRA, you should also think, well, I've got a third option, now, and that is I can use these qualified charitable distributions as a way to benefit charity.
Exactly.
So,
yeah, and then I think looking at a donor advised fund when it comes to timing and maybe being able to double up on certain deductions and things like that.
Great planning technique. So, and I think again the important thing, maybe the last takeaway is that charitable planning is it's a part of the broader picture of holistic wealth planning for the family. It's a piece of the puzzle. We need to make it fit in where it fits.
Yes.
Yeah. So.
Well,
hey, thanks for the time. This is great. And we appreciate your time and attention to this. We're Precedent Wealth Partners. Let's talk.